Hello again, and welcome back to Profit and Sense. Today we're talking about something that affects almost everyone at some point, but most people don't really understand. That's your credit score. What is it? How is it calculated? Why does it even matter? And most importantly, how can you actually improve it? Let's take the mystery out of it and break it down in plain, simple language. First things first. A credit score is a number that represents how risky you are to lend money to. Think of it as a kind of financial reputation score. Lenders, landlords, phone companies, even insurance providers might use it to decide if they want to do business with you and on what terms. The higher your score, the more confident they are that you'll pay them back on time. And that can mean better interest rates, higher credit limits, or even just getting approved at all. A low score doesn't mean you're a bad person. It just signals more risk to lenders, which can make borrowing more expensive or difficult. But where does this number come from? It's calculated using the information in your credit report. Your credit report is basically a record of your borrowing history. It includes details like loans, credit cards, payment history, balances, and even things like missed payments or defaults. Let's talk about what actually impacts your score. The single biggest factor is your payment history. This is whether you pay your bills on time. Missed or late payments hurt your score more than almost anything else. The lenders want to see you can reliably pay back what you owe. Next is how much you owe relative to your available credit. Then there's the length of your credit history. The longer you've had accounts open and in good standing, the better. It shows experience managing credit over time. This is why it can actually help to keep older accounts open, even if you don't use them much. Another factor is the types of credit you use. A mix of different kinds of credit like a mortgage, car loan, credit card can show you can handle different responsibilities. But don't open new accounts you don't need just for this. It's only a small part of your score. Finally, there are credit inquiries. When you apply for credit, lenders do what's called a hard inquiry on your report. A few inquiries here and there are normal, but too many in a short time can look desperate or risky. Now, let's clear up a common myth. Checking your own credit score is considered a soft inquiry and does not hurt your score at all. In fact, regularly checking your own report is a good way to make sure there are no errors or signs of fraud. So why does your credit score even matter? Well, it affects more of your life than you might think. If you want to get a mortgage, your credit score can decide not only if you get approved, but also what interest rate you get. A better score can save you tens of thousands over the life of a loan. When you want to rent a flat, landlords might check your score to see if you're likely to pay rent reliably. It's car loans, credit cards, personal loans all. These depend on your score. Even mobile phone contracts and some utility companies might check it. Now let's talk about how to improve your score. First, pay your bills on time. Every time. Even one missed payment can drag your score down. Setting up direct debits or reminders can help. Second, reduce your credit card balances. Try to keep your utilization low. Paying down debts doesn't just save you on interest, it improves your score over time. Third, avoid applying for lots of credit at once. Too many hard inquiries in a short time can hurt your score. Space out your applications and only apply for credit you really need. Fourth, keep older accounts open, unless there's a fee or other downside. Having a long credit history helps show lenders your experience at managing credit. Fifth, regularly check your credit report. Mistakes happen. Fraud happens. You have the right to dispute errors and get them corrected. And remember, improving your credit score isn't instant. It takes time. But small, consistent steps pay off. It's not about gaming the system. It's about showing you're reliable, consistent, and responsible with money. One last point. Credit scores aren't the only thing lenders look at. Your income, employment, existing debts, and other factors matter too. But your score is often the first thing they check, and it can open or close doors before you even get to explain yourself. So the more you understand your credit score, the better you can manage it. It's not about being perfect. It's about being aware, making good choices, and knowing how the system works. So it works for you, not against you. If you found this helpful and you want more friendly, no-nonsense explainers on how money really works, please subscribe to Profit and Sense. Thanks for watching, and I'll see you in the next one.